Welcome back, my friends. U.S. shale frackers are now giving OPEC Plus a real run for its money with record production in 2023. The EIA has forecast total U.S. output will hit 12.61 million barrels per day in 2023. This eclipses the previous record of 12.32 million barrels per day. In Q1, U.S. shale attracted most of the overall increase in capex spending. Energy security concerns were one of the drivers behind this surge in spending. Are U.S. oil frackers finally getting out in the field and getting their rig counts up? Is U.S. oil production capacity finally going to reach its potential? What does this mean for consumers? What does this mean for energy markets? What does this mean for oil companies? What does it mean for the U.S. economy? And what does it mean for the future of the United States? But, before we get into all of that, please hit the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. And, before we continue, a word from the sponsor of this video. Today's sponsor is InnerLife.com, creator of the InnerLife STS system. InnerLife STS is a cloud mobile platform for mental health care and its integration with primary medical care. InnerLife STS is designed for assessment, data collection and analytics, documentation, and progress tracking. InnerLife STS creates and composes conceptualized narratives and builds them into professional-grade reports. These reports are designed for use by mental health professionals, primary care physicians, justice system professionals and universities and include mental health assessment reports, mental health treatment reports, and treatment progress reports. And InnerLife STS uses doctor-selected pseudonames for all patients. So, only the healthcare professional knows the patient identity. For those of you not familiar, fracking, short for hydraulic fracturing, is a method of extracting natural gas and oil from shale rock formations deep below the Earth's surface. The process involves drilling a well vertically and then horizontally into the shale rock formation. Once the well reaches the desired depth, a high-pressure mixture of water, sand, and chemicals is injected into the well to fracture the rock and release the trapped natural gas or oil. The sand injected into the well is used to prop open the fractures, allowing the natural gas or oil to flow more easily to the surface. The chemicals added to the water help to reduce friction, prevent bacterial growth, and dissolve minerals in the shale. Last year, oil prices hit multi-decade highs shortly after Russia invaded Ukraine, prompting the Biden administration to urge U.S. producers and OPEC to ramp up production at a faster clip so as to rein in spiraling oil prices. However, Saudi Arabia and its allies responded by doing the exact opposite, cutting production when oil prices started plummeting. Predictably, the United States and Europe were irked by the cartel's defiance, with President Joe Biden's administration accusing Saudi Arabia of colluding with Russia and supporting its war in Ukraine. Well, President Biden can at least thank his lucky stars that the U.S. shale patch paid heed to his clarion call. U.S. crude oil output is up 9% year over year, blunting OPEC's efforts to keep supplies low in a bid to goose prices. There is little doubt the U.S. shale patch is largely responsible for keeping oil markets well supplied and oil prices low. Rystad Energy has estimated that whereas OPEC and its allies have announced cuts amounting to around 6% of 2022's production, non-OPEC supply has made up for two-thirds of those cuts, with the U.S. accounting for half of that. Energy experts have generally been bearish about U.S. crude supply, with many arguing it has already peaked. The projection suggests the pace of U.S. shale growth, one of the few sources of major new supply in recent years, is slowing despite oil prices hovering at around $90 a barrel, about double most domestic producers' break-even costs. If the trend continues, it would deprive the global market of additional barrels to help make up for OPEC Plus production cuts and disruption to Russian supplies amid its invasion of Ukraine, Bloomberg said. Bloomberg cited comments by ConocoPhillips, NYSE, COP, CEO Ryan Lance that rising costs as well as limited supplies of labor and equipment were some of the problems that were hamstringing efforts by U.S. shale producers to quickly ramp up production. However, Bloomberg also noted that the biggest factor behind the slowdown is a change of the playbook by the majority of U.S. shale companies from focusing on growth and expansion to more capital discipline and returning more cash to shareholders. Luckily for the shale patch, improving drilling and cost efficiency not only means they are able to squeeze more for less, but they are also able to eke out a profit at much lower oil prices. According to J.P. Morgan, U.S. drilling and fracking costs have declined 36% since 2014, significantly lowering the break-even points of many producers. For instance, JPM points out that increased efficiency means EOG Resources, for example, can earn as much from oil priced at $42 per barrel today as it would have from $86 per barrel in 2014. In contrast, Saudi Arabia reportedly requires about $81 per barrel to balance its books. The U.S. shale revolution dramatically reshaped the world energy markets. The shale boom was one of the most impressive growth stories, from takeoff in 2008 to the Permian stealing the mantle from Saudi Arabia's Ghawar as the world's highest-producing oil field in a little over a decade. Overall, Reuters has estimated that U.S. petroleum production is at least 10-11 million barrels of oil per day higher than it would have been without horizontal drilling and hydraulic fracturing. Unfortunately, the shale patch has lately been struggling to ramp up production due to a litany of challenges including pressure from investors to boost returns, limited equipment and workers as well as a lack of capital. But shale giant ExxonMobil Corp. NYSE, XOM, is now betting that shale producers can double crude output from their existing wells by employing novel fracking technologies. There's just a lot of oil being left in the ground. Fracking's been around for a really long time, but the science of fracking is not well understood, Exxon Chief Executive Officer Darren Woods said Thursday at the Bernstein Strategic Decisions Conference. Woods has revealed that Exxon is currently working on two specific areas to improve fracking. First off, the company is trying to frack more precisely along the well so that more oil-soaked rock gets drained. It's also looking for ways to keep the fracked cracks open longer so as to boost the flow of oil. Luckily, the U.S. shale patch won't have to wait for Exxon to perfect its new fracking technologies. There's already a proven technology for oil producers to return to existing wells and give them a second, high-pressure blast to increase output for a fraction of the cost of finishing a new well: shale well refracturing. Refracturing is an operation designed to restimulate a well after an initial period of production, and can restore well productivity to near original or even higher rates of production as well as extend the productive life of a well. Refracking can be something of a booster shot for producers. A quick increase in output for a fraction of the cost of developing a new well. While refracturing has never really gone mainstream, the technique is seeing higher adoption as drilling technology improves, aging oil fields erode output, and companies try to do more with less. According to a report published in the Journal of Petroleum Technology, new research from the Eagle Ford Shale in South Texas shows that refractured wells using liners are even capable of outperforming new wells despite the latter benefiting from more modern completion designs. JPT also estimates that North Dakota's Bakken Shale straddles some 400 open-hole wells capable of generating in excess of $2 billion if refractured. A refrac can be up to 40% cheaper than a new well and double or triple oil flows from aging wells. Fowler says the most common refrac method involves placing a steel liner inside the original well bore and then blasting holes through the steel casing to access the reservoir. The process typically uses half as much steel and frac sand than a new well. Refrac makes a lot of sense in the current inflationary environment. Back in April, Texas shale producer Callon Petroleum Company revealed that frac sand, drill pipe and labor costs have increased drilling and well completion service costs around 20% year over year. Callon and Hess Corporation, both of which drill in North Dakota's Bakken Shale, have been forced to hike capital spending budgets over the costs, with Callon adding $75 million to its original budget while Hess added $200 million to its spending. Techniques like refracturing will allow the industry to continue to harvest the oil and gas out of these reservoirs, said Stephen Ingram, a regional vice president at hydraulic fracturing firm Halliburton Company. Another key benefit: refracs do not require additional state permits or new negotiations with landowners. They are also less disruptive to the environment because well sites already have road access. Considering inflation, supply chain issues, and rising wages, now is a great time for operators to start looking at wells for refrac opportunities, Matt Johnson, CEO of energy consultancy Primary Vision Network, has told Reuters. Refracs have also demonstrated higher recovery rates. Fracking in the United States has seen a decline in recent years for several reasons. Global energy reliability concerns are triggering a surge in oil and gas investments. After Russia invaded Ukraine, expected investments in fossil fuels in 2022 and 2023 surged by $140 billion, Rystad Energy Research shows. Before the war, the two-year total was projected at $945 billion, but as the war sparked shortages and sky-high prices, expected spending has jumped to almost $1.1 trillion. Of the $140 billion growth, Shale production attracted most of the limelight with an additional $80 billion increase, as activity climbed 30% and pricing for oilfield services jumped nearly 50%. Offshore production accounted for $40 billion in growth, while other onshore activities expanded by an additional $20 billion. The White House's top energy advisor Amos Hochstein called shale drillers un-American. That is because of their refusal to boost oil production. 10 years ago, frackers always increased production when prices rose by even a little bit. But oil investors have been burned in recent years. But what do you think? Please hit the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.